Thank you for joining us today for Cryptocurrency 101. My name is Elizabeth Muse. I'm the Senior Director for Global Engagement and UVA Clubs in the Office of Engagement. You might have heard about Bitcoin and cryptocurrency, but you don't know where to start. And really, you might not actually know what cryptocurrency is. Well, today we're here to discuss the basics, the 101 of cryptocurrency. Before we get started, I want to note that this session is for information purposes only. Information and opinions that we share during the webinar are not intended to be any form of promotion, recommendation, offer, or advice to purchase or sell cryptocurrencies, securities, or investments products. This is for information only and for our fun. Now, let me introduce our crypto enthusiasts. Mike May serves as the Director of Finance in the University of Virginia's Office of Advancement, a position he has held since 2017. Prior to coming to UVA, Mike worked as an investment analyst in the family office in Alexandria, Virginia. Mike received his BA in economics from the University of Rochester and an MBA from Georgetown University. Chris Mercincavage is a cryptocurrency and blockchain enthusiast with a particular interest in teaching the fundamentals of these emerging technologies. Chris received both a Master's of Professional Studies in Information Science from Cornell and an academic certificate in Blockchain Essentials. Chris comes to us from Ithaca, New York, where he has supported Cornell's alumni affairs and development efforts for nearly a decade. Now, before I turn it over to Chris and Mike, we have a poll to get an idea of how many UVA alumni and friends in the audience have already participated in the cryptocurrency market. So let's launch that poll. There it is. All right, we're waiting for folks to give us the results. This just gives us an idea of who in the audience owns cryptocurrency. That gives us a little bit of an idea of what your knowledge is. We build this as a 101. We also know that we've clearly got some folks who really love cryptocurrencies simply by the questions that you submitted in advance. So thank you for participating in the poll. I'll let our magic technicians on the back show the results when we're ready. So wow, okay, this is fantastic. So we have 22% of the participants who are logged on at this moment, and the number I can already see is increasing more and more as we go. So 22% of you have cryptocurrency that you already own. That is absolutely fantastic. And for those who are joining us, we were asking a poll question, and we'll sort of circle back to that a little bit later. So as we're moving forward, if you have questions that you'd like to ask, something that sparks your mind, please go ahead and put that in the Q&A box as we move through the presentation. And now I'm going to turn it over to Chris and Mike. Thank you so much for walking us through Cryptocurrency 101.
Hey, everybody. And thank you, Elizabeth, for your introduction and for this wonderful opportunity to speak to the UVA alumni community. It would be fair to say that I am just a little bit enthusiastic about cryptocurrencies. And I hope that you'll find this presentation interesting and helpful as we learn more about this topic together. Now, just for good measure, bear with me one more time for a big disclaimer. Cryptocurrency is highly speculative and the most volatile asset class that exists today. Let's just clarify what this presentation is and what it is not. This presentation is an intro to cryptocurrency, an overview of the fundamentals of how it works, a brief overview of where the technology stands in 2021. This is not investment advice, trading advice, or any kind of financial advice. We are not able to talk about what cryptos you should buy or exactly how to purchase them. But at the end of the presentation, I will suggest some resources that I have found especially useful in informing my own education. With that out of the way, let's look at our agenda. Today, we will be looking at who is the typical owner of cryptocurrency? Just what is cryptocurrency? What is a blockchain and how does it relate to crypto? What is Bitcoin and what are altcoins? Who is paying attention to crypto? And finally, we'll look for a moment at how crypto is being used in philanthropy today. Now let's start. Who owns crypto in the US? We want to look at the demographic trends. There are currently 21 million Americans that own crypto. That equates to about 14% of the US adult population. As you can see from this pie chart on the left, nearly 3/4 of current crypto owners are men, and the average age is about 38. However, as you can see from the chart on the right, the majority of people interested in purchasing crypto are women. The crypto curious also skews to an older demographic now. So I think this shows that the appeal of crypto really is widening. Let's look at ownership trends in 2021. More than 2/3 of US adults are interested in owning crypto. The number of crypto investors is set to nearly double this year. And for the first time ever, more women than men are interested in getting into crypto soon. Education is crucial in initiating or increasing engagement with crypto, which is what we are doing here today. The next wave of crypto buyers are likely older with slightly smaller yearly incomes than current crypto owners. Next, we want to consider Bitcoin and other cryptos as an emerging asset class. Since the first Bitcoin block was created in 2009, Bitcoin and later cryptocurrencies have seen explosive growth over the course of their short lifespan. As an asset class, Bitcoin and all other cryptocurrencies make up over $2 trillion in value. Here you can see how they compare to other asset classes. Crypto is nearly 1/5 of the size of gold, which has been around for thousands of years. Not bad for something that launched in 2009, but it still pales in comparison to the equity and bond markets. So, what is cryptocurrency? From a high level, cryptocurrency is digital money that exists only in cyberspace. Traditional national currencies such as the US dollar, the euro, pound, or yen are backed by governments, are often referred to as fiat currencies, a term we'll use throughout the presentation. These fiat currencies have relative value depending on the stability and fiscal discipline of the government that issues it, while cryptocurrency relies upon math. Both fiat and cryptocurrency values are driven by marketplace forces of supply and demand. Now, it is important to note that there is no physical form of any cryptocurrency, such as coins or paper bills. You may have seen gold-colored coins with a B stamped on them. Those are just physical renderings and do not represent actual Bitcoins. Again, Bitcoins and all cryptocurrencies only exist in a digital form. Cryptocurrency is secured by cryptography in an online ledger. And as a result, the networks themselves are highly secure. Because we will be using the term ledger often moving forward, here's a quick refresher on what a ledger is. The concept of a ledger, which is primarily meant to serve as a record for transactions, has been with us for all of recorded human history. At first, transactions and the transfer of property were recorded on clay, wooden tally sticks, stones, and papyrus, possibly manually tallied with an abacus. In more modern history, the process of recording transactions progressed further when paper was invented, and even further again as the expanded normalization of computers occurred in the 80s and 90s. Cryptocurrency represents the continued evolution of the digitization of ledgers. Bitcoin was the first cryptocurrency. Again, it began in January of 2009. It pioneered the use of a decentralized ledger, or a blockchain. We'll talk more about blockchain on the next slide. Since there are currently over 11,000 cryptocurrencies in existence, with more added every week, that is not to say that all have or will ever have value. it is likely the majority of these coins will not ever have utility. So doing due diligence on specific crypto projects is necessary to really understand the use case for each. Cryptocurrencies are bought and sold on exchanges. Exchanges work in a similar fashion as an online brokerage account that you may use to buy and sell stocks, exchange traded funds or ETFs, and mutual funds. Crypto can also be withdrawn from exchanges and placed on secure electronic wallets by users for an additional layer of security. Next, we need to talk about what is a blockchain. Blockchain is the underlying technology that enables Bitcoin and other cryptocurrencies to function. Blockchain is a distributed ledger, meaning there is no central ledger. An example of a central ledger would be a bank, where all customer account information is housed on servers within that bank. So if you're a customer of that bank, you have a risk, hopefully a very small risk, that your servers could ever be compromised, which would put your banking information at risk. Blockchain helps to mitigate that risk by distributing the ledger. Blockchain is a shared immutable ledger that facilitates the process of recording transactions and tracking assets. It is decentralized technology spread across many computers, or nodes, spanning the globe that manages and records transactions. This removes the possibility of tampering by a malicious actor and builds a ledger of transactions you and the other network members can trust. New transactions create new blocks. As each transaction occurs, it is recorded as a block of data. Each node on the network validates the transaction, following the protocol built into the code. Once each transaction is verified, it becomes a block and is added to the blockchain. Transactions are blocked together in an irreversible chain, which is what you can see on this graphic in the bottom center. Blockchains are virtually unfalsifiable. Each additional block strengthens the verification of the previous block, and hence the entire blockchain. This renders the blockchain tamper evident, delivering the key strength of immutability. Blockchains create more secure databases. The Bitcoin blockchain is secured and verified by nodes and miners across the globe. We'll define these in more detail on the next slide, but suffice to say for now, these nodes and miners record a public history of each transaction on the blockchain that secures and validates the ledgers for all users. Blockchains can be public or private. Blockchains have different goals when it comes to the privacy of their users and transactions, which allows for many different use cases. So, if this is your first time seeing how blockchain works, you may still be scratching your head. It is a difficult concept to grasp at first. If you're interested in learning more, I would suggest checking out IBM's resources on this topic. They created a blockchain for dummies. Not that we were calling anyone on this call a dummy, but it is a great resource you can find at ibm.com/blockchain. So, Bitcoin. There's a few terms we need to define before we move forward. Let's start with the basics. Here are a couple terms that are important we clarify before we continue. Nodes. A Bitcoin node sounds like an impressive thing, but really it's just a simple computer that is running the Bitcoin program. Over my shoulder, you can see an old desktop computer. That could be a Bitcoin node. A Bitcoin node could easily be run on a small microcomputer like this Raspberry Pi. Essentially, anyone with some basic hardware can run a Bitcoin node in their own home. More importantly, a Bitcoin node is a computer that is connected to other computers running the same program. This network of computers makes up the Bitcoin network, and this network spans the globe. Now, the other term we need to define are miners and the term proof of work. Now, this is not mining in the traditional sense that you know. like digging gold or silver out of the ground. This is digital mining, where powerful computers are competing to solve complex math problems to expand and secure a blockchain ledger. I have a miner in my basement, and it does not look too dissimilar from a desktop computer. This machine works to secure Bitcoin, and there are thousands of other enthusiasts and even companies providing this 24/7 security to the Bitcoin network. With that out of the way, let's talk about Bitcoin itself. Bitcoin was created by the mysterious Satoshi Nakamoto in 2008, and it launched in January 2009. Satoshi is likely a pseudonym. No one knows who that person actually is, though many have theorized who it could be. I would encourage everyone to visit bitcoin.org, where you will find the white paper that Satoshi Nakamoto released describing the workings of Bitcoin. Any new cryptocurrency worth its salt now starts with a white paper to describe its vision, but none have yet matched the profound impact that Bitcoin has had. In its simplest form, Bitcoin is a peer-to-peer online payment system. Bitcoin uses the proof of work, or mining we just defined, as a method for growing and securing its blockchain. One of Bitcoin's most attractive attributes is that its hard cap on supply is only 21 million coins. There will never be more than 21 million Bitcoins in existence. This makes it deflationary by design. Bitcoin cannot be printed like fiat currencies such as the US dollar. Increasingly, investors are looking at their own assets and looking for ways to hold their value as fiat currencies are debased by deficit spending and central bank money printing. Like any asset, Bitcoin is only worth what someone will pay for it. Bitcoin may be too slow for a payment network right now, but it could preserve value and wealth for people over the long term in a world where governments around the globe are spending way more than they take in tax revenue. Bitcoin is a store of value. Some even go so far as to call it digital gold. Bitcoin has many of the same attributes as gold. It's durable, it's scarce, divisible, and recognizable. One attribute of Bitcoin that bests gold is its portability. If you wanted to move your Bitcoin from the US to, say, South Africa, you could hop on a plane with your smartphone and be done. If you wish to move 1,000 ounces of gold the same distance, you could have customs issues, insurance costs, and shipping costs. At a minimum, for all these reasons, Bitcoin has grown to be viewed as a store of value, a protector of wealth over the long term. And I do want to emphasize long term. Yes, it is a very volatile asset, but historically speaking, the trend has been up. Just last week, El Salvador made Bitcoin legal tender in their country, and it is buying Bitcoin as an asset to hold for the long term. Bitcoin is really distinguished from all other cryptocurrencies. It was created to be secure digital money in a world where inflation and money printing are ever-growing concerns. Bitcoin is decentralized and non-sovereign. Traditional finance largely relies on institutional or sovereign trust. Bitcoin creates a network that is robust in its unstructured simplicity. Nodes are decentralized and redundant. Trust is replaced by math. Nodes work all at once with little coordination, and they do not need to be identified because messages are not routed to a particular place. There is no central authority that controls the flow of transactions. Rather, they are secured by the participation of all nodes on the Bitcoin network. And these nodes are at liberty to leave and rejoin the network at will. Miners not only generate more Bitcoin, at least until the 21 million cap is reached and nodes take over to validate transactions, but they secure the network through decentralization and redundancy. Incentive is built into rewards that motivate miners and nodes alike to operate, and the whole Bitcoin community is strengthened by this. This system has created the most secure computer network on the planet. Next, Bitcoin is immutable. We are 12 years on, and Bitcoin has never been hacked. Even when a node leaves the network for a period, it can rejoin in full faith that the blockchain will be accurate when it returns, thanks to the proof of work chain. A great example of the resiliency of Bitcoin can be seen in China's recent decision to outlaw it. Nodes and miners in China represented the largest percentage of users on the Bitcoin network, and many worried that their departure would mortally wound Bitcoin. While the Bitcoin network slowed temporarily, the incentives built into the network that I talked about earlier worked beautifully. The network quickly rebounded in other locations around the world and is now approaching its performance before the Chinese miners were taken offline. Bitcoin nodes and mining are more decentralized today than ever before. The price of Bitcoin is driven principally by supply and demand fundamentals. Capped at 21 million coins, Bitcoin is a beautiful example of pure scarcity in action. The most valuable cryptocurrency today, Bitcoin makes up approximately 43% of the entire value of cryptocurrencies in existence. So now that we've defined Bitcoin, let's talk a little bit about how it works. Bitcoin is a worldwide peer-to-peer network. Miners create or earn Bitcoins by using high-powered computers to solve complex mathematical problems. This same process verifies transactions on the network between buyers and sellers. Exchanges act as an on-ramp to crypto from fiat currencies, offering a way into a market as well as a way out. Each user on a crypto network such as Bitcoin has a unique wallet, and this address works a little bit like an email address, providing a way to store and receive cryptocurrency. Bitcoin can be transferred from one wallet to another by using something so simple as a web browser or an app on your phone. If a business wanted to accept Bitcoin or another crypto as payment for goods and services, it would create a wallet in much the same way. It could create a website button to enable a quick Bitcoin payment. Brick and mortar merchants can also use QR codes to let customers pay quickly and easily. So I think we've covered the many positive arguments in favor of Bitcoin. Now I want to address some common arguments against it. And I think this will address some of the questions submitted by you all beforehand. So the first big argument against Bitcoin is that it is a bubble, reminiscent of the tulip mania in the 1600s. If anyone isn't familiar with the tulip mania, it was a period in the early 1600s in the Netherlands, where prices for some tulips reached extraordinarily high levels before crashing in 1637. This has become the model for the general cycle of a financial bubble, where investors lose track of rational expectations. The dot-com bubble in 1999 or 2000 is another great example. One may argue that Bitcoin is not real money, and as such has no real value. It's just a computer program that can be hacked or changed in a way that makes it worthless. Only time will tell. The price of Bitcoin has fallen 70 or even 80% on multiple occasions, only to come back and make new highs. It would take a very large external shock to render Bitcoin permanently worthless. Another argument against Bitcoin is that governments will shut it down. After all, central banks want to be the only game in town when it comes to spendable currency. They do not like competition. There is even talk of central bank digital currencies, with China likely being the first to roll one out. While certain governments could make it illegal to own or tax it at punitive rates, crypto remains a non-sovereign form of money. If some governments ban it, others will embrace it, as we are seeing now with countries in South America. As long as the sovereign individual exists, one can always take their Bitcoin to where one's individual liberties are respected. Bitcoin is also widely criticized for its use in illicit activities. It is true that a small percentage of transactions in Bitcoin are used for unlawful activities. That percentage decreases as the network expands. In addition, the same can be said about the US dollar, which is widely used in finance to pay for illicit activities. Is anyone talking about shutting down the US dollar? I don't think so. Not for this reason. Because of blockchain technology, every transaction can be tracked and traced on the Bitcoin network, including those transactions that are part of illicit activity. In addition, many of the world's largest crypto exchanges run and know their customers and have anti-money laundering surveillance systems, KYC, AML, similar to those used in the banking system. Now, another big argument against Bitcoin is in terms of its energy usage. A large percentage of Bitcoin mining used to take place in China, and this was primarily powered by coal-fired plants and some hydroelectric. Now that China has banned Bitcoin mining and exchanges, the mining operations are more evenly divided across the globe, with the US and Canada swiftly emerging as new leaders in the space. This shift in geographical influence for Bitcoin mining has led to many new and cleaner approaches to mining. There are many new examples of how Bitcoin mining operations are currently helping to create new energy innovations, including mining companies in Texas signed contracts with electric utility companies to run their miners only during off-peak hours. And they are prepared on short notice to shut their equipment off to assist the local utility company when insufficient supply is available. This assists not only the utility companies by providing them with a way to stabilize the supply, but it also helps to protect customers from high electrical costs that occur when the grid is overworked and peak pricing takes effect. In this way, mining companies are securing the stability of the electrical grid for the entire community. In my home of upstate New York, where hydroelectric opportunities are abundant, companies are opening new renewable energy powered ventures. In one case, a mining company happily took over the operations of a historically preserved hydroelectric power plant in Mechanicville, New York. The plant had not been profitable for a long time, and this was due to their inability to cut a profit selling their renewable electric to the local utility company. It had long languished. Bitcoin mining added the missing profitability variable that now allows the plant to operate at a profit and has added a renewable source back into the local electrical grid. In both the US and Canada, Bitcoin mining is also taking a novel approach of putting equipment on trailers and coordinating with oil and gas companies to use stranded, low-volume gas deposits that would not usually justify a pipeline. In the past, this energy was typically flared and therefore entirely wasted. Bitcoin miners are innovating in ways to harness energy previously thought unusable. Finally, the Bitcoin Mining Council recently released a report that found Bitcoin mining electricity has reached 56% sustainable power use in 2021. So we've talked about Bitcoin. Now we need to talk about the other 11,000 plus, the altcoins. So what are altcoins or alternative coins? They are every cryptocurrency other than Bitcoin or alternatives to Bitcoin. And the altcoin market has seen explosive growth over the last few years. Altcoins currently make up about 58% of the total crypto market cap. These cryptos are primarily building utility for financial transactions. Right now, many of those networks are still being built out, so the prices of these cryptos are driven by expectations for future use cases. In other words, there is a lot of speculation in this market. Some will succeed and many will not. Some cryptos are already being used to facilitate real-world transactions today. Let me share a few use cases to give you an idea. XRP is being used to facilitate cross-border payments, increasing speed and lowering costs for users. They're competing with the likes of Western Union and the SWIFT network. Litecoin was designed to have higher volume and transaction speeds than Bitcoin. Many would like to call Litecoin digital silver to Bitcoin's digital gold. Litecoin could potentially be more attractive for retailers as a payment option. There is enthusiasm in the crypto community for this to happen, and it has happened already with some online retailers. Unfortunately, some false stories have occurred. Many of you may have noticed the story in the news yesterday that turned out to be completely false, that Walmart was going to start accepting Litecoin. This caused an immediate spike in Litecoin's price. And as soon as the news story came out, and it was even shared by Reuters, as soon as it was proven false, it came crashing down again. Dogecoin began as a joke in 2013, and now it's championed by the likes of Elon Musk. Zcash is focused on user and transaction privacy, and this is accomplished through passwordless permissions and zero-knowledge user verification. Many brilliant minds from MIT are working on this project. Sia, Storage, and Filecoin are examples of decentralized digital file storage tokens, and they would like to compete with the likes of Amazon and Microsoft, or even Apple, for online storage market share. Cardano is a direct competitor with Ethereum, which we will discuss now. Ethereum was invented in 2013 by programmer Vitalik Buterin. And yes, Vitalik is a real person. And it went live in 2015. Ethereum is currently 19% of total crypto market cap, and it's the second largest behind Bitcoin. Ethereum has no supply cap. An innovative feature unique to Ethereum is the Ethereum virtual machine, which could one day lead to a new internet. Ethereum also features smart contracts, which allow programmers to build decentralized applications, also known as dApps, hosted and governed on the Ethereum blockchain. This topic is beyond the scope of this presentation, but one that I would highly encourage you to research after. Smart contracts, in short, are self-executing contracts with the terms of agreement between the buyer and seller being directly written into lines of code. The code and the agreements contained therein exist across a distributed, decentralized blockchain network. The code controls the execution, and transactions are trackable and irreversible. Smart contracts permit trusted transactions and agreements to be carried out among disparate, anonymous parties without the need for a central authority, legal system, or external enforcement mechanism. Smart contracts have a plethora of potential applications, including banking and financial service contracts, prediction markets, crowdfunding, wills, real estate, titles, essentially any contractual agreement that traditionally required an intermediary or broker could conceivably be replaced by a smart contract. There is also a rapidly expanding developer community and lucrative jobs for those who wish to learn the Solidity programming language that drives the Ethereum blockchain. It is swiftly joining recognizable programming languages such as Java, Python, C++, and others as a growing force. The demand for blockchain specialists grew 517% in 2020 alone. So now that we've looked at some cryptos, let's look a little bit at institutional adoption. Now, this is increasing, and you can see from headlines as I've posted here, Fidelity has become the first Wall Street firm to launch a crypto branch trading desk. TD Ameritrade is making major investments and creating their own exchange. Now, if any of you followed Bitcoin or cryptos on Twitter, you'll often see great enthusiasm and a lot of questioning about when the SEC might warm up to a Bitcoin ETF at last. And Robinhood, a very popular traditional stock trading app that many millennials have on their smartphones, has a crypto business, and it's huge. So let's also look at increasing expectations from investors. JP Morgan, Wells Fargo are both launching Bitcoin funds. Paul Tudor Jones, a UVA alumnus, calls Bitcoin a great speculation, and he has almost 2% of his assets in it. 90% of Fidelity's biggest clients are asking about Bitcoin. and Morgan Stanley becomes the first big US bank to offer its wealthy clients access to Bitcoin funds. Let's also look at growing media coverage. Bitcoin and crypto are increasingly in the news, and it is hotly discussed among not just technologists, but actors and more politicians as well. Jack Dorsey, Elon Musk, Peter Thiel are all involved in the crypto space. And even actors like Ashton Kutcher or popular politicians today are discussing and debating what crypto means for the future of finance. Now, another topic I want to touch on real quick about crypto is what cryptocurrency could mean for philanthropy in the future. Harvard, Yale, and Brown have been buying Bitcoin for their endowments. Wharton this summer received a $5 million Bitcoin donation, the largest crypto donation in Penn history. Ripple, who make XRP, donated over 50 million to 17 different universities to boost blockchain and crypto adoption. And back in 2017 and 2018, there was a famous story that came out about the Pineapple Fund, where an anonymous donor gave to hundreds of nonprofit organizations through Bitcoin, up to a total of 55 billion. So let's look at real quick, why would someone donate crypto? Well, cryptocurrency is treated as property for federal tax income purposes. Donating appreciated crypto is tax efficient for donors, similar to donating appreciated stock. UVA now accepts cryptocurrency gifts of $5,000 or more, and this is thanks to the diligent work of Mike May on this presentation. And finally, according to a recent CNBC millionaire survey, nearly half of millennial millionaires have at least 25% of their wealth in cryptocurrencies. This is a significant trend, and this is a great reason for nonprofits to take crypto seriously and to engage these potential donors on their own terms. Now, in conclusion, I want to propose some additional resources to help you if you found this topic interesting and would like to learn more on your own. There's a lot of opportunity to learn about new innovations, new opportunities, and ideas that make cryptocurrencies and blockchain such an exciting space to follow right now. There's a great deal to consider about this topic, and this presentation could easily go on for hours. And even after that, we'd hardly scratch the surface. To spare you having to listen to my voice for that long, I'd strongly recommend you consider the following resources as you begin your own investigations. Resources I'd suggest you begin with for learning more about cryptocurrencies include CoinMarketCap, Messari, and Gemini has something called Cryptopedia, which is a great resource for looking up terms, concepts, and bits about how the technology functions. And finally, as we mentioned earlier in the presentation, IBM has a great guide on blockchain. So one last thing to note, we did receive a lot of questions about taxes, in particular about how capital gains on cryptocurrencies may be calculated. We suggest that you speak with your tax advisor about any of these concerns. Cryptocurrency is a nascent industry that has grown very quickly. The industry is working with regulators to promote clarification, recognition, and legitimacy. Now, with that note, I just want to say in conclusion to thank you for this opportunity to present to all of you. In many ways, this was basic, but there is a lot to learn about crypto, and I hope that this can be a great starting point for some of you. Now, Elizabeth is going to share some of your questions for Mike and I to answer. Thanks.
Chris, thank you so much for getting us started with that amazing tutorial. As you said, there is so much there to be able to go through when you helped walk us through concept by concept by concept. And now we are going to move into the question and answers. For those in the audience, please do put those in the question box. Mike is going to help with this process to get us going forward. I'll start us off with a couple of questions that were pre-submitted, and then we'll just move in a casual conversation as we go through here. Chris said, it's Question was submitted. Do you think that cryptocurrency will be accepted and used more in mainstream transactions such as buying groceries, filling up your car, or doing things like that in the future? And if so, how soon do you think we might be using cryptocurrency for that?
So that's a great question. And I'd start by saying for many online retailers, it's a reality now. I love playing with computer hardware, building desktops, things like that. And there's a very popular company in the US called Newegg. And right now you can go on newegg.com and you can place an order in Bitcoin, Litecoin, or I think 7 other cryptocurrencies on there right now. Now, other big companies are catching on to this. Whole Foods, Overstock.com, Home Depot, BMW, currently only the UK section of it. They all accept crypto. If you have any gamers in your family who love to play Xbox, they may be aware already that the Xbox store actually accepts cryptocurrency. Now, also a major news article many people on this may already be familiar with is Tesla Motors was playing with Bitcoin earlier this year. The company has a big holding of it. And early in the year, they announced they were actually going to accept Bitcoin towards getting your Cybertruck or whatever vehicle. They pulled back, citing some of the energy concerns we addressed earlier in the presentation. And now it's kind of up in the air. Tesla's still holding Bitcoin, but it's unclear whether they're going to accept it as a mode of payment moving forward. And, anytime someone could get on social media like Twitter and see that people are hyping up like, well, maybe it'll be Dogecoin or something like that. Who knows? But there's growing adoption. And I think moving forward, Bitcoin will most likely continue its trend as a store of value. But you might see some of these lighter, more flexible cryptocurrencies being adopted on a growing basis.
Thank you so much. Another one for any parents out there. This one was fantastic. It said, my 12-year-old son is excited about trying to mine Bitcoin. Is it really worth it? So if you want to do that from the parental perspective, and then also for anybody that might be interested in mining, we've got sort of the 2 different angles on that. And then Mike, after that, we'll kick it over to you for a question coming in.
So one angle on that is I would have everyone consider is right now we're going through a chip shortage. Microprocessors, it's affecting everything from automotive to home computers, cell phones, everything. So hardware is expensive, and getting to the point of being profitable takes a lot of research but the thing I would highlight is if your 12-year-old wants to learn how to mine cryptocurrencies, awesome, because they're going to learn how they work. And once they get hooked on it, they're going to keep researching the other components of the technology. And there are, if you have a decent modern desktop with a modern graphics card in it, there is stuff you can do, maybe only a few dollars a day, but you can learn and set them up to do mining. But most importantly, it's more engaging with the concepts of what makes a blockchain function that I would encourage someone to say, yes, if your kid wants to do that, go for it. There's a ton of resources on YouTube on how to get started. And I would actually start there.
Fantastic. Thank you. Mike, do you have a question from the audience you want to toss out there?
Sure. So there are a lot of questions on Bitcoin and the 21 million Bitcoins that will only ever be in existence. A lot of people want to know how many have been mined to date. So I could start, and maybe Chris add a little bit more if I miss anything, but I believe there's about 18.8 million of them have been mined to date. And so when miners are mining and they receive Bitcoins for answering those complex math problems, every 4 years, the amount of Bitcoins that they would receive is halved. So that's how we get to like a theoretical 21 million coins. I'm not sure if I'm explaining it that well, but the number of Bitcoins they get for solving those complex math problems will decrease by half every 4 years. So it's like it gets smaller and smaller. And actually, there's 18.8 million, but A lot of those were mined when Bitcoin first started and people lost them. I think the estimates are probably like 3 to 4 million of them are actually lost. They lost their keys, their private keys to that Bitcoin. So in practicality, when we get closer to the 21 million theoretical, it'll probably be a lot less than that are actually in existence and able that people actually have ownership to. Chris, I don't know if I'm missing anything there. Do you have more on the halving?
Yeah, all I would add to that is it's kind of been an escalating almost arms race amongst miners since Bitcoin really started taking off. I mean, in the first couple of years that Bitcoin existed after its launch in 2009, it was really, really easy to mine Bitcoin. You could do it with a desktop computer. People had, thousands of them. There was a famous story about the first purchase used with Bitcoin, and it was, through fiat. Someone bought a pizza with a large sum of Bitcoins that could buy a house now. So what you've seen with the mining is as we get closer and closer to that 21 million number and the last Bitcoin is minted, it's getting more and more competitive to get them. And that's definitely fueled the explosive growth in value of Bitcoin over the last several years.
Well, adding on to that is a question that was pre-submitted, is with that limited supply of the crypto of coin in of itself and the proof of work and the white paper that you had talked about, is there something to stop it from having a Bitcoin 2.0 or a Bitcoin 3.0? It sounds like the mathematical equation and that proof of work that you've been discussing limits it to that 21 million. Is there a likelihood that there's going to be a Bitcoin 2.0 behind that?
I think one of the big advantages, and Mike, feel free to jump in here at any point. One of the big advantages that Bitcoin has is it was first to market with really, really solid fundamentals. I mean, it has that first name recognition of this is the founding cryptocurrency, and it's designed to, be scarce and has a cap. A lot of these altcoins, not all of them, but a lot of them don't have a market cap. They could be minted in perpetuity. And, it depends on their use case. You really have to research what are they trying to do with it. It doesn't make as much sense for something like XRP, which is for cross-border payments, to function like gold. But, Mike, you may have something you want to add on this topic too.
Yeah, I think it's just, I think with Bitcoin, it has a first mover advantage. So it's considered valuable. I mean, like we said, there's 11,000 plus, and not all of them will have value. I think it's, they definitely have to have something significant behind it. And like I said, Bitcoin has that first mover advantage. It was put together, like people think it's rock solid security wise, just the whole halving, the scarcity of it. So it's attributes like that, I think, that makes crypto valuable. There could be something that comes along that bests Bitcoin in the future. We will have to see, but it's a pretty solid project, I think.
I think a good example, Mike and I were discussing this earlier today, and one example Mike brought up was, the iPhone. I mean, Apple is king of smart devices in the United States because they were the first to market with something that worked really, really well. And, someone may dethrone Apple down the line and overtake the iPhone, but it's not happening yet, and it's going to be difficult to do.
And I think along that same vein was another question, and you did address it in the presentation when you were talking about the alternative coins or the altcoins and the alt currency, is that there are new ones popping up. And as you just mentioned, Chris, was understanding what they're trying to accomplish with that currency, with that blockchain. How does one, and this is a 101 class, right? So we were just learning the basics of the 101, but how do you evaluate what might be the next Bitcoin if it's not some of the ones that you already mentioned? What's that process look like for you?
So I would start first with, go read at bitcoin.org, read that Bitcoin white paper. Once you've digested that and feel you have a little bit of a handle, and there's a multitude of resources, YouTube, all over the internet, you can read to clarify it if you're struggling with a section. But from there, these resources we shared at the end, like CoinMarketCap or Messari, each of these not only lists what these coins are doing in the market, but they're also listing the websites for the developers. And on those websites, you will also find white papers. You'll find media stories. If you're a programmer, you can go on GitHub and see a lot of their code. You can see what developers are involved with these currencies. You can see who's investing in them. And I think what's most important is, have they developed something that works, or are they feasibly going to? And then on top of it, are they actually meeting a real market need that either someone hasn't yet or isn't doing as efficiently as crypto could? So I would look at all those, and the thing is, there's over 11,000 of these things, and they're popping up all the time. A friend of mine and I we launched our own Ethereum based crypto a little while ago just to try it. We'll never develop it. Maybe, we'll see. But you could, and that'd be another great thing. Going back to, having your 12-year-old learn the mine. If they want to learn the code, get them into Solidity now. Solidity is growing fast, and they can do cool stuff like they can launch their own Ethereum token. They can name it whatever they want, coin, and then they can actually start playing with the fundamentals of what are the basic economics of this token. How many do I want to mint? Do I want it in a forever minting? What's my angle? What do I want this to do? And that would be a great thought experiment too. But look at these resources, look into the projects, who's developing, who's investing, what are they trying to accomplish? And really, that's not that dissimilar from looking at any tech company.
Mike, do you have a question that you want to toss out there from the live Q&A?
Sure, yes. We have a good question from Carl. He says, guys like Charlie Munger and Warren Buffett of Berkshire Hathaway, Jamie Dimon and JP Morgan, Jerome Powell, who's the chairman of the Federal Reserve, and others think that individuals should stay away from Bitcoin. These are trustworthy folks. Should I not listen to them? So I'll kind of go one by one with them. So Jamie Dimon, he did say that Bitcoin, he didn't like it. And that was probably a year or two ago. And I think, as you saw in our slides, JP Morgan's actually launching a Bitcoin fund now. So I think he has warmed up to it a bit. And then Charlie Munger, Warren Buffett, both in their 90s. And as you can see, the demographics of crypto definitely skews much younger audience. I wouldn't expect them to like it, or even they're billionaires. They don't need crypto. To me, if I was one of them, I probably wouldn't spend much time looking into it and would call it snake oil as well.
The thing to look at with crypto too is not just the financial value of each coin, but going back to what they're trying to accomplish, there's a lot of use cases for what crypto could achieve, including, the next iteration of what does the internet look like. Ethereum, that chart we showed back there for dApps, most applications route through some kind of centralized server that might be backed up in redundancy a few times. But the beauty of a distributed blockchain ledger is every device that's connected to that network is ensuring it and securing it. And that has a lot of applications for all kinds of things beyond financial, value.
I'll ask a question that I was thinking about as you were giving the presentation. I think it was Litecoin, but correct me if I'm wrong, that had a market spike because of fake news, right? So your great public relations thing. You they say that something has occurred and then it is not. You sell at a high point, any of that thing. So can you talk about the speculative nature, right? We started this presentation by saying this is something speculative. This is for information only. And this is what we can learn. Can you talk about that nature It's not just true to cryptocurrencies, right? There's a way to manipulate stock, and we're talking about that manipulation of currency. Anything about that experience with Litecoin, if that was the correct, and what that might have shown you or made you think about in this market?
So yeah, that's a great question. So what happened with Litecoin is, Litecoin has been adopted by several online retailers, but people are really hyped about what's the next big one. Is Amazon going to announce they're accepting cryptocurrency? Or in this case, someone released a fake story that Walmart had signed a deal, and it got a lot of traction. Reuters retweeted it. People got all hyped up, and Litecoin shot up from like $170 a token to $240 or something like that. Then the news came about that no, this isn't real, and it crashed right back down. So the thing to keep in mind with crypto is there's a term that you'll see on social media that's called FOMO. And FOMO means fear of missing out. So what happens is some hot news story comes in. Everybody's like, oh, this currency is going to go up 100-fold, just like Bitcoin did back in, whenever. And they all jump on, they all pile on, and then everyone's trying to get out before the top. And, some people do make a lot of money doing that, but it's essentially day trading, and there's a lot of risk with that too. So my own experience, and I'm just, as I just said at the beginning, I'm just an enthusiast and a hobbyist in this space, but taking the long view on these currencies is important. If one fake news story is going to wreck you financially, cryptocurrency is probably going to be dangerous for you. But if you look at it long term as what can this technology accomplish, what might it do, and where might it be in 10 years, that's where I get excited about this space.
Thank you. And one of the questions that someone asked is, what happens to cryptocurrency if the internet shuts down? And that'll be our final question for either one of you. So what happens to cryptocurrency if the internet goes?
Well, I guess think of it this way. What happens to your bank account if the internet goes? What happens to your entertainment? What happens to your ability to connect with government services? A lot can go really, really wrong if we ever have a global internet outage. Now, I would point back to the way we discussed a blockchain works. These are computers across the globe that are all running the same program. They're all verifying what each other are doing, and they're backing it up. So if the internet went down, the ledger would pick up right where it left off if those computers survived this apocalyptic scenario and were able to rejoin. If a section of the world went down, if the US lost internet for an extended period of time, well, Germany's number 2 for nodes. Germany would keep the ledger up to date, keep it running until we were able to rejoin. So that kind of resiliency is also a technical aspect of Bitcoin and other blockchains that I find really exciting. And I think we'll have a lot of applications moving forward, however they develop.
Fantastic. Well, I want to thank you both so much, Mike May, Chris Mercincavage, for your time today. For everyone in the audience, please know that we will follow this session with an email later in the week. We'll provide links to the resources that have been discussed, as well as recording of the session, because something like this, you want to go back and watch it again, because that's when it all starts to come together. That way you can continue your journey, your learning about cryptocurrency. So many, many thanks for everyone for joining us today, and wahoo wah.
Thank you. Bye.
Thank you.